instead of from Japan. Okay. Now, in general, we're not so sure about this. We have some positive effects and some negative effects. And whether it's good or bad for a particular commodity, well, probably this is an empirical question. So we would have to carry out some research and study in order to find out exactly how China may be affected in the case of pure import. Okay. And also, we can have some other types of trade. One thing is intra-industry trade. Okay, so suppose that there are some machines or some types of cars. Okay, China is producing and also exporting to some other countries. Okay, and at the same time, some other countries may also be exporting similar products to China. So in that case, China may be exporting and importing similar products at the same time. One example is what? Smartphone, maybe computers, some types of machines, and so on, camera or whatever. Okay, so basically, it is quite common that a country is exporting and importing goods that are similar to each other and also that are usually grouped within the same industry. Now, this is what we call intra-industry trade. And now, if for some of the goods that are having intra-industry trade between China and some other countries along the line, so the question is, having this kind of high-speed railway, is it a good or a bad idea for China? Well, again, this is an empirical question because, we can identify some positive effects and also some negative effects. So in general, we are not so sure. Okay. Now, it seems that anything can happen, but actually it is not. We can have a theoretical framework to help us understand or identify these positive effects and these negative effects, and then we can actually carry out empirical estimation. But what it needs would be some data, okay? But unfortunately, the data are not that available online. At least we have to spend an RA to get an RA to get the data. So unfortunately, I don't have any numbers with me. But at least, you can have a conceptual understanding of how different countries may be affected for different types of trade. Okay, now let me turn to the business opportunities. Okay, now of course I am not a business person, so I do not know business that much. But I think the initiative is a huge project affecting so many countries and for so many years and in many industries, and therefore a lot of business opportunities must be created. And that is why we need to pay attention to this. And so I basically, I try to make use of the stages of the construction here in order to identify the kind of opportunities that we can pay attention to. Okay. And after that, I'll talk about risks and also risk management. Okay, now, here, I would focus more on the construction of the initiative. So the construction would occur in stage 2. Okay. Now, in general, we don't know what exactly the length of that stage 2 is because, it depends on what kind of railway we are talking about, which country we are talking about, and what is the properties of the land. Okay. That we are talking about. Okay, so we don't know exactly how long it will take, so that is why I put 3+ here. Okay, so this is the construction of the project. After that, we have trade. Okay, something I have explained already, and also within this range, okay, we have local development. Now that is the macroeconomic effects that I mentioned earlier. Okay, so the local economy is going to receive the positive benefits from the initiative because they are the local economy is receiving some investment fund, okay, and it may receive foreign direct investment from outside companies as well. Okay. Okay, now let's go over these stages, okay, and see what we can expect. Okay. Okay, now, so we need to know what kind of goods and services would be needed for before our company would be able to determine how it can benefit from the initiative. Okay, and so during the promotion and negotiation process stage, probably that's not much outside companies can do. Now, that is mainly the responsibility and the work of the Chinese government. Okay, so for us, well, not much to do. But that does not mean that we don't have to do anything. We actually, if I am, a potential investment firm here, I would start collecting information and data and of all these countries, okay, so that I know, well, whenever an opportunity arises, I know immediately that, what I have to do, okay. Okay, now, during the project construction stage, okay, so basically, you are going to build high-speed railway or building seaports and so on. Now, by the project itself, there may not be too much other companies can do. The project usually would be carried out by the China Railway Construction Corporation. Okay, so basically that is a state companies, and it would carry out the construction using its own technology and so on. So probably some other firms may not be involved too much, okay, unless they may be able to the suppliers of some of the parts and materials used for the construction of the railway. Okay, now that is something other countries can do. Okay. And furthermore, if the project is being financed by the AIIB, so that was the report that, for projects financed by the AIIB, companies in the member countries would receive some kind of priority. So that may be something firms would want to be aware of. But more important would be the local development. So if you still remember the diagram earlier, the local development starts at the time, roughly at the time of the beginning of the construction of the project. The reason is that when foreign companies or the Chinese government or AIIB injects money into the economy would get the benefit nearly immediately. Because, maybe you send money there, and then you hire the workers, and therefore the workers would receive income, and they would spend the income, and so on. So the local economy would benefit. Now, that means we have investment opportunities for some outside companies. Okay, now in the third stage, we have trade. Trade, okay, I just mentioned some examples earlier. Okay, maybe Sri Lanka may want to buy cars from Germany because of the maritime Silk Road. And now, of course, that is good news for some of the companies in Germany. But that is not the only thing that we would expect, because Sri Lanka may want to buy may want to buy goods from some of the countries along the line, along the road. Okay, so in that case, some other countries may also benefit as well. Okay, so all these kind of goods and services needed for the completion of the project, and also the trade encouraged by the project would call for production of some of these goods to be traded, to be exported, to be imported by some of these countries. And also here we have, when we are talking about possible investment, actually we may have two levels of investment. The first level is, of course, for each of the countries, the 63 countries that we just mentioned earlier. For each of these 63 countries, maybe for a particular company, we may want to, determine, if I'm going to invest there, for example, Kazakhstan, okay? So if I'm going to invest in Kazakhstan, so how much should I invest? Okay, what is the optimal level of investment in which industry and also how? Okay, now you determine all this. Okay, now that is the first level or the lower level of investment. Now on top of that, you have the higher level of investment, the second level. Okay, and that is companies usually will have a limited money for foreign investment. Okay. It does not mean that you can send as much money as you want to other countries for investment. Okay, so suppose that you have a fixed sum of money, and now you have 63 countries, and in each of these countries, you may have already determined how much you are going to invest. Now, what you are going to do in terms of this fixed sum of money, you have to allocate. You have to allocate this fixed sum of money. So how much money I should send to this country, how much money I should send to another country, and so on. Now that is the level we should determine. Now it seems to be complicated, but of course it is not. You write up a program, and then we run some computer program, then we can get the result very easily. And of course we may have to be aware of the existence of economies of scale. For example, we may want to invest in India. We may also want to invest Bangladesh. Okay. Now, maybe you just need an office. Okay, in somewhere in India, say Calcutta. Okay, so you have a regional office in Calcutta looking over the investment in India and investment in Bangladesh. Now, this is a kind of economies of scale that, of course, the companies should be aware of. Okay. Okay. Now, let me turn to the last topic. Okay, of my talk. Okay, I'm already tired. Okay, but that is about risk management. Okay, and you probably know the meaning of risk management. That is to identify risks and also to mitigate the risk associated with a particular investment. Okay, that is the risk management that we would be looking at. Now, when we talk about the initiative, and also when we are trying to talk about investment because of the initiative, one thing we have to know is that investment is risky. It means that, it can bring you benefits, it can bring you profits, but the profits sometimes may be negative. That means that you may receive losses. Okay, so investment is risky. Okay, because we don't know about the future. Okay, and also investing in a new country is especially risky. The reason is that when you're talking about a new country, then that country may be an entirely unknown thing for you. It's a black hole over there. Okay, so if you decide that you want to invest over there, you may have to face a lot of uncertainty and risks. Okay, and that is something you should be aware of. And also, a new country may have a different language, may have some different legal system, different economic system, and different culture, and so on, or different manager-worker relations, and so on. So it's actually very risky to invest in a new country. Okay, but of course, in order to choose to invest there, you must expect to have high return. Okay, otherwise you would have no incentive to invest. Okay, so you want to have a high return, and in many cases you may expect that well, if things go wrong, go right, okay, then you may have some high reward. Okay, hopefully. Okay. Okay. Now, in that case, how can we decide whether we should invest, and how can we manage the risks? Okay. Now, here I proposed something called the extended expected return approach. Okay. Now, the expected return approach is something you may be aware of, but I want to extend it, okay, in the sense that, well, we can be more aggressive than what the traditional expected return approach would suggest. Okay. Now, the expected return approach is based on something like this. So I use a simple illustration, okay, assuming that there are only two states of nature, the good state and the bad state. Good state means a good day. Bad state means a day like today, raining with thunderstorm or whatever. Okay, so it is a bad day. Okay, so suppose that you are selling ice cream. Then if you have a good day, then you have a lot of customers. Then you can do a lot of business. But if you have a day like today, then probably no one would want to buy ice cream from you. So that is a bad day, not just in terms of the weather, but also in terms of your business. Okay. So of course, that is only a very simple illustration, but we can use that as a way to illustrate how risk can be managed. Okay. Now, in order to determine what we can get from this investment when facing these two states of nature, okay, we can have well, the return that we can get, okay, or the revenue, that would be the revenue for an ice cream vendor if you have a good day. So I use G to represent the revenue that you can get from a good day. Okay, B would be the return that you would get if you have a bad day. Now, B can be negative. Okay. And P is the probability of having the good day. Okay, having a good day. So since there's only two states of nature, so if P is the probability of having a good day, then 1 minus P would be the probability of having a bad day. Okay. Now, if you want to have one more example, then I can use another example. Now, I'm not going to encourage gambling, but something like that. So suppose that you want to throw a dice, okay, and if then you come up with a number facing up, okay, with the face, okay, facing up. Now, if you get an even number, so suppose that someone is going to give you $100. If you, after throwing a dice, you get an even number. But if you get an odd number, then you have to pay that person $100. Okay. So in that case, using this formula, the G is equal to 100, B is negative 100, P is equal to what? So as long as this is a fair dice, then you have 50% chance of getting an even number and 50% chance of getting an odd number. So P in this case is equal to 0.5. And also 1 minus 0.5 is 0.5. So as a result of that, you substitute all these values into this equation, you get E, which is the expected return of throwing a dice, okay, to be 0. Okay. Now, based on this, then the expected return approach would say that you would decide you would invest if you get an expected return greater than 0. Then you go ahead and invest. Now, in this case, you get an expected return to be 0, which means that, well, you will be indifferent between throwing a dice, gambling, or doing nothing. Okay. Okay. Now, this is the expected return approach. Okay, and also this approach can be extended to rank two projects. So suppose that you have two projects, and these two projects may have different returns and may be facing different states of nature, and then you can calculate, therefore, the expected returns for these two projects. And then the approach would say that you choose the project that would give you a higher expected return as long as that expected return is positive, okay, or non-negative, okay. So in that case, we can therefore use this to try to choose different investment projects, okay. Now, there are some issues associated with this approach, okay. One is that, this approach suggests that the decision maker is risk neutral. Risk neutral here means that, you are not particular fond of risks. You don't like to, you don't enjoy risks, okay? And also, you don't like to avoid risk too much, okay? So, risk to you does not mean anything, so that means that is why it is called risk neutral. So this is one assumption behind this approach, okay? Now I'll talk more about this later. Oh, okay, actually, this approach, okay, this assumption actually is not consistent with something that we observe, okay, for people going to casinos, okay, to Macau or whatever. Okay, so you go there and gamble, okay. But we all know that, the odds against the gamblers in all casinos are negative, against. So the odds are against the gamblers. Okay, that means if you go to a casino and gamble, basically you are losing in the long run. Okay, so if you gamble indefinitely, okay, then you are going to lose. Okay, now if that is the case, that means that when you gamble, then your expected return actually is negative. So if you use this approach, then you would say that, okay, I should not gamble. Okay, now if you follow my advice, then you should not do that, okay? So you should not gamble, okay? But I'm using this example to raise your interest, maybe, okay? So we are not able to use this approach to explain gambling. One way, of course, is to say that, people like risks, so they are risk-loving lovers, okay? And therefore, they get enjoyment from taking the risk, okay? And therefore, they are willing to gamble even though the expected return is negative, okay? Now, but we should not use this argument to explain the behavior of the governments. The reason is that the government is making the choice for people. Okay, so in that case, the government should not take too much risks. Okay, so the government should not behave like a gambler and try to enjoy risks. So that is nonsense. Okay, so the government should not be risk-loving. And on the other hand, government should not be too risk-averse. Okay, meaning that you should not avoid too much risk. You should not do that. Okay, you just take risk neutral. Okay, because you are spending other people's money. Okay, so you have to make the good choice. So that's why when we talk about say project evaluation, then we can assume that the government is risk neutral. Okay, another issue is the volatility. That is, we may have the expected return like this, but the return may jump up or this or down, up, and so on, so that the expected return is something like this. Now, if you have two projects, one is having a particular expected return, and then you have another project of the same expected return. But then for the other project, the return may not be so volatile, so maybe it's not moving that much. Now, if you know this, then of course you would choose the one with that is less volatile. Okay. Now, of course, that in some sense you are away from the risk neutrality assumption. Okay. But at least in the market, we have a way to describe this volatility and how that may affect your decision. And the most important model is what we call the capital assets pricing model. So basically, the model tries to show the trade-off between volatility, something you don't like, and also expected return, something you like, okay? And try to show the trade-off between these two. But this model actually is not too applicable here. The reason is that, you are talking about initiative, something that has not happened before. Okay, so you cannot, say, the capital asset pricing model to try to estimate what we call the beta coefficient to show the volatility of a particular stock as compared with the volatility of the market as a whole. Because you are talking about a particular and very unique project. Okay, so in that case, that model is not too applicable here. And as a result of that, we should, I think we still should rely on the expected return approach, okay? But here I want to suggest that maybe we can do something slightly better than the traditional expected return approach, and that is what we call, that's what I call the extended approach, extended expected return approach. Now, why is that? And what is that? Okay, so basically, if you go back to the previous equation, then we know that the expected return depends on three parameters. One is the return when we have a good state, and the return when we have a bad state, and also the probability of the good state. Okay, so basically we have three parameters, and in applying the extended return approach, we assume that these three numbers are given, or at least we have confidence in the values of these parameters. Okay, and then we plug in the values of these three parameters, and then try to see whether the expected return is positive or negative. Okay, so that is the usual approach. But actually, we can do something more than that in most cases. Okay, okay. Now, in that case, what we can argue is that maybe we can try to spend money on improving the expected return of a particular project. Okay, so in this equation, E is the expected return that we can derive from the early equation, and except that now in that equation we assume that the values of some of the parameters can be altered, can be improved. Okay, C is the money that we spend on improving the expected return, and therefore the profit or the return to the government is equal to the new expected return minus the money we spent. Okay. Now in this case, the money we spend is something we would be able to calculate, and E is something that we would have to do some estimation and so on. Okay. No. Okay. Now in that case, we'll try to see how we can improve the situation. So basically, I want to argue that we try to spend money on. Go back to the equation. Now, so we try to improve E, but how can we improve E? Now there are three ways. Since we have three parameters,